All right. Um, Good evening, guys. Hope you all are doing well. Um, I'm a little tired, but we are here today. So yes, let us begin. We have some work in front of us that we need to do. So let's get through it. Anyway, so this afternoon we are going to be looking at topic 3. So we're going to be looking at topic 3, which is very short because it's an introduction to the other cycles that we're going to be looking at in lesson 4, lesson 5, lesson 6, 7, 8. So let us start. So here, um, topic 3 is about transaction cycles. Now, where does this fit in, right? In topic 1, we covered corporate governance. In topic 2,
Internal control.
internal control, right? The 5 components. And then topic 3 um, is what we are doing now, right? So it's important to know those 5 components. There's actually a few stuff that we were not able to finish touching on. Like what is it? Let me actually just do this. I don't think it's open here. Yeah, it is this side. It's D. C part D and then E. And knowing this. So this actually stuff. That's it. That's where it ends. So it's not that much. It's just um this. Yes. All right. So hopefully when we get time we can go back to it. But as for now, let us go to let's focus here. So here we're going to be looking at topic 3 is about how the accounting system actually works and introduces the 5 transaction cycles that every later topic will dig in, you know. And so basically here is more about the map before like you explore that place, right? So here we have the accounting information system. Every business does dozens of different activities, right? Buying inventory, selling goods, paying staff, renting building, taking out loans, and so on. Each activity needs decisions, and each decision needs information, which can be financial or non financial, from inside or outside the business. So basically, it's saying here that we looked at it actually in the morning when we were looking at accounting information system. Mobile actually asked me an important question about that. You know, there's an information system in a business. Think about Standard Bank. Standard Bank has a lot of departments, right? Standard Bank has the marketing department. Um, they have the finance department. They have, you know, like I'm sure there's so much, to be honest. Finance, there's a leadership maybe department. There's a, I don't know, like in that finance there could be retirement and so on and so on, sub departments and so on. So there's a lot of departments that you can find in one business, right? So here we are looking at the accounting information side of it. So what is accounting information system? So it is the platform that integrates all this information from different sources so management can use it. An accounting system is a series of collection of tasks and records by which transactions are processed to create financial records or financial transactions or financial statements. It identifies, assembles, analyzes, calculates, classifies, records, summarizes, and reports transaction and other events. Transaction. either one, an agreement between two entities to exchange goods or services, or any other events that can be measured in economic terms by an organization. So, what the accounting information system must define for every transaction is the initiation, what triggers the transaction, and how is it approved. Second, we have recording. How and at what point does the transaction first enter the system? Three, processing. What further processing or transferring happens to it after it's recorded? And last but not least is posting slash reporting. So how does it eventually reach the general ledger and end up in the financial statements? So this is like a process, you know, from initiation to recording, to processing, and then to reporting. That's what the accounting information system must be able to define in every transaction. Be able to see, be able to know, okay, what triggered this transaction and how and at what point that's recording and then this processing, then this reporting. Now, what is a transaction cycle? A transaction cycle begins with capturing data about a transaction and ends with an information output such as the financial statements. All right, just want to zoom in a little bit. You're not allowing me to do stuff. All right, it's cool. Um, Transactions don't flow from the business randomly, they flow through cycles, also called business processes. And here we have five major cycles. Today, hopefully, uh, today we're gonna look at revenue and receipts cycle. Hopefully, be able to finish it. We don't know. It's quite there. It's quite a lot. So we have revenue and receipts cycle. This is sometimes called sales and collection cycle. So when you hear sales and collection cycle, you know that's the revenue and receipt cycle, and it makes sense as we're gonna look at it. It's about the sales that you make and how you collect. So it's almost like it tells the process of it, right? Revenue means sales, right? So, and collection cycle. So it's that process. Acquisitions and payment cycle. That's the second one. We have inventory and production, third one. Payroll and personnel, fourth one. And last but not least is finance and investment cycle. So the revenue receipt cycle, what is it about? It's about selling goods and services and collecting the money owed, um, ap- approving credit sales, invoicing, receiving cash slash EFT, and chasing debtors. So this is what this is where we actually sell something, and they could either be there's a lot here. Here they could either be like they could be returns. It's basically the core um the core part of the business where you're selling something, you're selling clothes. So this is where um the selling of goods and services, this is where money collected. People can buy on credit, people can buy, cash, they can pay EFTs, they can pay online, for example, online there's different ways to pay, right? You know that there's like an EFT and then there's like literally online. And you see this when you actually try to pay online. You could be buying from Takealot. Uh, you could even just be, I don't know, paying for like a ticket to go to watch uh, Justin Bieber or something, or go watch Lebo Matosa. But obviously, Amen. She's not there, but I'm just, local artist, right there. But yeah, so there are different even ways to pay on like online. So that's what you're gonna be looking at. Here we have acquisition and payments. This is about buying and selling and paying. So now we are the ones buying here. Here we are selling when it comes to the revenue and receipt cycle. But acquisitions and payments, the name kind of says it. What we're going to be doing, which is buying goods or services and paying suppliers slash vendors, where we'll have purchase orders, receiving goods, approving and making payments, inventory and production. There it is as well. That's what they will talk about, and payroll and personnel. That's what it talks about, and finance and investment. That's what it talks about. Um, I don't want us to now stick and explain more because we will get there. But since you'll have this PDF, you can just be able to read one sentence about it. And this is where you can find it in your auditing notes, chapter 10, chapter 11, chapter 12, chapter 13, chapter 14. In fact, I was actually looking at it right here. This chapter 10, revenue and receipt cycle, which, just to show that it's important to actually like really interchange this, and don't just stick to these notes, but also use your auditing notes. There's even companies regulations. This is more so in lesson one. There's so much that one can use to just better understand the information we're given. So now, um, how transaction cycle fits into internal control. Remember, we looked at this in the morning. Topic one. Internal control has five components. Those five components are crime, right? But don't just say, hey, those five components are crime. This is an abbreviation. C means control environment, R means risk assessment, okay. Information systems, that's for I. Uh, control activities, um, and monitoring. Wait, this I, which one is M here? M is monitoring. So then, who's E? Yeah, no. Yeah, you just understand. Once it goes to the end, forget. But yeah, this is a control, environment, risk, information, control activities, and monitoring. Um, yes. So that is crime. It's actually not an abbreviation. It's a mnemonic. What is this actually? Hold on. Oh, what is this? Is it a C here? Mnemonic. This is assisting or intended to assist memory or relating to memory. Ah, so that's more like a way to remember it, more than an abbreviation. Meaning, it doesn't need to be like E needs to stand for something, but it's more like remembering. I think Mobile said something in the morning about, what did you say? There's something you shouldn't do. Is that what you said?
Oh, wow. I said it's a crime for auditors not to use
Yeah,
internal control.
a crime for auditors to not use if they don't use it, basically. Yeah, so that's a better way to go about it. But also a great way is just to say five components, so you know that, well, once you've touched CRI and M is monitoring, you know that the other one is control activities, you know. But yeah, so here it reads, picture it as the control environment. The control environment wraps around everything. Inside that sits the information system, which contains the accounting system and its five transaction cycles. constantly interacting with risk assessment, control activities, and monitoring. None of these five components work in isolation. They are all interlinked, and a weak control environment undermines all the others. Now, here, what we see is the textbook stresses that the auditor must obtain a thorough understanding of which class of assessments are significant to the financial statements. For example, sales, wages, the manual and the IT procedures by which those transactions are initiated, recorded, processed, reported, the related accounting records and supporting documents, and information, how information, not just transactions. And here, for example, of those transactions can be like contingent liabilities, lease renewal options, fair value estimates, also flows into the financial statement. So here, where it all ends up. This all ends up in the financial statements. To look specifically to revenue and receipts, typical statement of financial position items. Here, it's usually trade and receivables, cash and equivalents. Typical statement of comprehensive income, it is revenue. And that is all for lesson 3. Now here, it's about what? Here, it's about the glossary, definitions, and that's really it. That's what this is about. So it's very short. Um, but my question is, do you guys understand so far? Is it making sense? So like we did in the morning, if you understood, just say yes. Unmute and say yes. We are recording now, Chief. So whoever's gonna watch this is gonna be like, "Keep on, why are they quiet?" They can't unmute and
Bro,
say yes. Yes.
bro,
Mm-hmm.
what I want to ask you that what you have done now is this like an introduction to what
It's
is
an
going to is
introduction.
what
Yes,
introduction.
that's what it is.
Okay.
Introduction to other cycles. That's
Is
what
introduction to cycles.
yes, transaction cycles, because it's different type, right? We looked at revenue and receipts. We're gonna look at other. Well, we're about to look at revenue and receipts in more depth, but there are also more. There are like 5 major transaction cycles.
Okay. I also saw that it touches on internal control and also on the financial statement, especially let me see, revenue and receipt revenue and receipt cycle. It has those components like that trade
And trade
receiver
receivables,
trade
yeah.
receivables like debtors and
Mm-hmm.
then cash and cash equivalent. Which item on the cash and cash equivalent falls in there? But cash and cash, is it bank
Yes, cash and cash equivalent is
only?
bank. It it's
Only
it's not only cash and cash equivalents can have what again?
like the petty cash.
Yes, can have petty cash, bank, and
So
yeah, I forgot what else.
all those components fall under the revenue and receipt. I think it's because of when how do they fall? Like I need the revenue and receipt cycle deals with so it for like I see receiving cash or EFT.
Mm.
Is that
So,
because of cash is banking?
mm-hmm,
I think
cash is
it's
bank.
because of that.
Yeah. Um, and it's just, I mean, it doesn't mean that every bank transaction will be here. It doesn't mean that. So we'll
Hmm.
look into that. And here it's about selling. You see here it's buying. You can even buy from others using bank. So it's not all the same. It depends on what that cycle is about, which is what we're gonna enter and do right
No,
now.
I mean for revenue and receipt, not
Yes.
acquisition. Yes.
Yeah, for
Yes.
revenue
Okay.
receipts, bank is also touched. Um, yeah, we'll see
So
though.
that's what they
We'll
say.
look. Yeah, we'll look more in depth. That's why they're saying receive cash and EFT.
Okay. Okay. Thank you.
All right. Now to actually look at. Okay, this is actually now we're looking at the other document. If you could go there. Now we're looking at the revenue and receipt cycle. Remember, this is a summary. This is a summary. Your auditing notes. Your best friend here. You see how many pages this has? Auditing notes. 70. And it's actually worth it. I'm not even gonna sit here and say it's not. This is absolute. Like, there's no way you're gonna read this about revenue and receipt cycle and come out here and say you don't know anything. There's no way you're gonna absolutely understand every single thing here. Unless, I mean, you generally don't, and then you ask, anybody that knows, you can ask me, I don't mind. But yeah, this is great if you just want to understand, you know, every single thing in its entirety. But we will be looking at this document, which also explains everything quite well. So yeah, now welcome to lesson 4. We are going to be looking at revenue and receipts cycle. So here, the revenue receipt cycle. Um, let us just go here. What is the revenue and receipt cycle? The revenue and receipt cycle, also called as the sales and collection cycle, covers the accounting system and internal controls a business uses to control: one, the sale of its goods; two, the collection of money owed for sales. Let's read that again, because here's the important thing. You need to understand what is this. And whenever you start something, you want to make sure you understand the start. You can't be like in the middle and like, let me try and understand now. This is very important to understand at the start, because even if you understand the start and you forget in the middle, when you say let me try to understand in the middle, you can be able to understand. So I think it's very important to know what it is. So to read again, the revenue and receipt cycle, also called as the sales and collection cycle, covers the accounting system and internal control our business uses. I think it's right. Business uses Our business uses to: one, to control, one, the sale of its goods and services; two, the collection of money owed for those sales. Every type of entity earns revenue somehow. A retail a retailer sells goods, like for example Mr. Price. A wholesaler sells to retailers, escorts to checkers. A service provider renders a service, Uber Eats, right? Their service is to deliver food. That's their service, Uber Eats. DHL is it usually deals with tires. I know they have other services and different things like that, but DHL is usually like tires, or like they check your tires and so on. A miner sells minerals, coal to Escom, and even a university renders academic services, Unisa. We're not buying anything in Unisa. They are offering us a service. So they are getting revenue from that. So the common thread is a product is sold or a service is rendered. So revenue flows to the entity. So the statement of financial position items, we have
accounts receivable, which is trade receivables, which are debtors, right? So debtors are what? Debtors are the people that owe us, right? And then we have cash and cash equivalents. We're actually talking about this where it could be bank, petty cash, and so on. Then we have statements of comprehensive income items. What do we have here? We have credit sales, money we made by selling or rendering a service on credit. Cash sales, someone paid in cash for our service or a product. Like you go to a grocery store to buy chocolate, you paid in cash. You know, if you had that 20 rand to buy that bawan. I don't even know if bawan is 20 rand these days. You might be surprised. But I actually haven't even seen bawan in a grocery store in these days. When last did I see a bawan? Actually, that's a good question, but let me not stick there. And then sales returns. This is when we uh return what people bought, and then discount allowed. Discount is allowed on that. Um, that could be credit losses, bad debts, interest received, all receipts, revenue, and other. Now, the characteristics of the cycle. Variation. Goods can be sold over the counter, online, by phone, or from a hard copy order. Sales can be instant or take a long time to complete. So here they're saying what can happen. So these are the different type of transactions that can happen where it is basically showing a variation of transaction where goods can be sold over the counter, goods can be sold online, goods can be sold by phone, um, goods can be sold for or from a hard copy order. Sales can be instant, cash, or take longer to complete, like us. Maybe in fact, Kosi, like in Kosi, you see there was a construction site there that she posted. Like good that she posted that there was like a construction there. So that thing is not gonna happen in one day. That noise will probably continue tomorrow. So that is an example, at least a very close one. And then we have cash sales. Cash sales, cash in a business. Um, so cash in a business is a security risk, potential for theft, physical harm to staff who handle it. Okay, now how do you know this? Do you actually believe in this? I can give an example. I don't know who has actually where is this? Okay, I have my own experience. See Rosebank, if you stay in Joburg. Rosebank in Joburg. In fact, this store is going cashless, which is Starbucks, where you like buy coffee and whatever. You don't pay cash there. You pay using card. Why? Because it's a security risk to pay in cash. Why is it a security risk? Because someone can just come there and point a gun and say, "Give me the money." But if it's using card, they can point a gun at you who works at that business and say, "Give me the money," because you don't have access to that card, that business card, that bank account. So it becomes less of a security risk if everything is via card because it's harder to access, right? And then we have credit sales, risk that the customer won't pay. Key control: check credit worthiness before the sale and collect amounts owed on time. Legislation: the Customers Protection Act, CPA 68 of 2008, applies to any entity selling to consumers. It protects customers against unethical sales practices and prescribes minimum invoice content. So now there are two sides of the cycle. Which cycle? The revenue and receipts. And we are going to look at these two sides of it. The first side is the credit sales, where the order comes in, the credit check, and then there's warehouse and picking. When I say warehouse and picking, it's literally, think about a warehouse. Think about Take a Lot. Where do you think those things are? Right, when they say you can buy online, they're in a warehouse. They are. It's very. I can't even say if it's even true. They are not in the store. They are in a warehouse. You see this. Uh, I can. I'm thinking about Deb example, but you can see this. Even in Joburg. In Joburg, if you are traveling to the from CBD, traveling to the airport, there's a volcano, like, because that thing is huge. You just know where you don't see it. There's a volcano, like a warehouse there. It's written volcano. Volcano is the headphone headsets company. The speakers, they have volcano speakers and things like that. So that's like their warehouse. So if you buy online and you're in Joburg, that thing comes from that warehouse. It doesn't come from anywhere else. When it comes online. So when they say warehouse and picking, people, you order online and you pay on credits. People then end up what? They go to that warehouse. Okay, this is what this person ordered, right? And then this dispatch. Dispatch means something leaves, exits, right? It dispatches, invoicing, right? And then you record the sale and debtors, and then receiving and recording receipts, returns, cash, slash credit management. So that is credit sales. Another great example is um what's this? Checker 66 or the Pick and Pay. Sometimes you ends up Pick and Pay, you see people with motor, like people working there actually at Pick and Pay. They are like putting stuff in those paper bags for people that order online. You see them picking items, picking items. Now, Pick and Pay is its own warehouse. Pick and Pay is its own warehouse because it doesn't make sense for Pick and Pay to have a warehouse that is not literally Pick and Pay because the food is gonna rot there. Like they it doesn't make sense for them to take stuff from there because they sell different stuff. Now maybe if what you're ordering at Pick and Pay is Jungle Oats, Jungle Oats can be in a website, in a warehouse, but when it comes to like cabbage, tomato, it's good that it's at Pick and Pay or at least at the farm than in a warehouse. Because if it's at the warehouse, it usually doesn't stay for too long. Yes. So then if you look at cash, a simpler, instant version of the same idea, but with much higher theft fraud risk because cash itself is the assets changing hands. Okay. So here how it looks like. So one thing about the cycle that I want to say is cycles are fun. Personally, I'm gonna say that. I'm gonna say that because you literally look at it in terms of this is actually happening. Like what happens when I buy something? Okay, it moves here to here. Okay, then moves here to here. So that's what the cycles are about. So to visualize it, number one, order department. These are people that deal with orders. They receive and authorize an order. Like for example, if you order something online, these are the people that receive it, and then they're like, okay, we have this in stock. Boom. That's why sometimes even if you try to order online, what does it say? Sold out. Because it's not there. So these are the people, number one of the order department. We have the credit management. They check the credit worthiness. Does this guy pay his credits? What is his credit score? Maybe we won't look at credit score here, but we look at the track record, the pattern. Or maybe we will. Let's see. And then the third is warehouse. Now we're picking up the goods from where they are. And then dispatch. this is where you deliver to the customer. And then we have recording receipts. This is where we credit the debtor's account. And then 7, receiving cash, receipts and bank the money. Recording sales journal and debtor raised. Right, and then hold on. Am I tripping? Yeah, I'm like, this doesn't make sense. Yeah, there was an error. This is not this is not making sense. So it starts at dispatch delivery to customer. There's an error here in this error. Discover delivery to customer, and then goes to 5. It's the other side. Yeah, that's invoicing and bill the customer. So once you invoice and bill the customer, you record this in the sales journal and debtors and debtor raise. So now this person owes us, right? And now when this person owes us, we receive the money that they owe us. Now what do we do? Receipts and bank the money. Then after that, record receipts, credit the debtor's account. So these people have paid it. Now we credit it. So here it says, note the collection of payments 7 and 8 and the processing of returns are also part of the sales function. The cycle doesn't end at invoicing. All right. Now, before I even move, does that make sense? Doesn't make sense so far. Obviously, we're going to look at this thing in depth. See order department. See, you're about to go into order department and look at it a little bit more. But does this make sense so far? You can unmute and just say yes. If it doesn't, you can unmute and say no. Bro, I think my chair's broken. This chair's broken. No.
Yeah.
All right. What are others saying?
Yes, bro. So far, it makes sense. But as you say that, as we move to other, what do you call it? Other, other functions or other things, it's gonna build up.
All right.
Okay.
What does level have to say? Yes or no?
Yeah, good.
All right. Awesome. Thank you for the feedback. Okay. Let us continue. So now we're going to be looking at the basic functions of the cycle. Now here, there are 8 functions here. And in these 8 functions, there's obviously the whole point of a cycle is the order. You have to understand what happens here. After this step, this happens. After this step happens. And the best way to go about, if you want to understand just anything, Jay, even in life, you must ask why. Kids are the best ones when kids will be like, why? Kids like asking questions. Even here, the best way to understand cycles is to understand why. Boom, why, and that will be able to make things more clear. So don't be afraid to ask why. And if I don't know, one thing about me, I'll tell you I don't know, because I do not know this textbook off by heart. But yeah, we are all here to learn. All right. So the first department we have is the order department. So think about this. I want you to visualize this thing, right? Visualize an order department. These people are probably sitting on their laptops, right? and then like something like a notification comes up. Oh, an order. Oh, someone is trying to order something here and take a lot. Okay, let's check if we have it. So that's how I want you to think about this. That's how I want you to think about it. So here is the orders department. So the orders department receive orders from customers. Whether the customer is phoning, hey, sorry, do you have this in the store? Do you have, I'm looking for a casual financial calculator. Do you have it there at CNA? Oh no, ma'am. It's not in the CNA. It's in the CNA in Bedford View. Oh, thank you. That's like that could be an example of a call, right? There's email. Yeah, if yeah. Email can be like maybe you bought online. When you get like an email of that confirmation that you bought online, which is something we're gonna look at here actually. And then it could be like a post and then over the counter. So over the counter is like in person. So order department receives orders from customers and sets the order in motion. Before processing, it confirms the customer's account is up to date within the credit record and terms, and that the goods are in stock. You see? I have to check. So this is what you have to think about. If somebody think about it like in your business, if somebody wanted to buy something from you, you can't sell them a dream. You know, can't sell them a dream. You have to actually check if you have that in stock. If I want a Vix, I have to get a Vix. I don't want to get menthol. I don't want to get. I don't know what else it could be. I want Vix, so that is important. So so here, check the goods that are in stock. If a customer is not within term limits, authorization must come from credit management. If out of stock, the customer must agree to a back order. Okay. So it's clear that they're gonna tell us what are those maybe credit limits and things like that. But all they are saying here is these people are in charge to see if to receive that order from customer. Like all customers to order something, they check if they have it in stock. They check if this person is in um credit limits. By the way, how I want you to look at this is that it's the we are looking at credit sales. We're not looking at cash yet. It's different. Cash is much easier. Like a lot of things here will just fly here in cash because probably credit management is not there. Well, not probably, it is not there. So yeah. So now we're in part two. So this is credit management. By the way, these people are buying um on credit. These people that are buying here. So now these people, they're trying to buy from us, and we check what's okay. Do we have this thing in stock? Do we have the, let's say, the Volcano speaker in stock? Maybe we find out that yes, we actually do have the Volcano speaker in stock, right? And then if we look at two, credit management and sales authorization. So here, what happens is basically authorizes the sale by granting or confirming credit before the order proceeds. Companies don't want to make sales they they won't be paid for. New customers complete a credit application. Existing customers are checked against their credit limits and terms. So here, if I own a business, I want to make sure if this person is going to pay me. And if this person has a track record that he has paid for other people, that's why credit score is also important. And that's why I probably, because I don't like buying things on credit, like if I don't have money to buy something, I just leave it. But that's why credit score is quite, um, it can be low or high. Is because if you have never bought on credit, we have no history. Like, Mina, how am I gonna trust J Kiss right? To buy some, she's about to buy a car on credit. But when I look at JK, she has never bought anything on credit, not even like a phone installment, nothing, J. So if I'm selling that car to her, what will I do? There'll be a higher interest. There will be a higher interest. I have to charge a higher interest on her. But if I can see that, oh, the JK's actually has, has paid for stuff before. Now that's when I'm like, all right, we can negotiate a little bit. We can decrease that interest. That's why, for example, if you own a car and you get insurance, if you're a new car owner, you have never had a car, it's your first time, your insurance is gonna be high. But as you continue driving, oh, your experience, you've been driving for 5 years. Oh, you've been driving for this many years and this many years. That's where you can renegotiate to get lower um, insurance. So hopefully that makes sense. Yeah. An easier thing is like somebody trying to. This is a great example. Like someone teaching you grade 12 stuff and you're in grade 12, right? But they are in grade 8. You won't listen to that person because they are not in grade 12. Like, I don't trust them, right? They don't have that track. Like, bro, you are teaching me grade 8 things and I'm in grade 12. So it could streamline to that and so on and so on. But yeah, that's what we are looking at here. And if it's a new customer, right? And here it says new customers complete a credit application. Existing customers are checked against their credit limits and terms. Now 3, we have warehouse and dispatch, which is picking. So select, so that's where you pick the goods per the internal sales order, right? Internal is the I. S, sales, O, order, internal sales order, picking slip, and controls the movement of goods from the custody section to the dispatchment section. So imagine we're in the warehouse, right? Now we're in the warehouse, right? As we're in the warehouse, this person's like, yeah, no, I wanted Volcano speak. Okay, we have different Volcano speakers. Which speaker did he buy? Oh, he bought the small one. Okay, so now we go there to that warehouse. We get that specific speaker. How do we know what is that speaker? We use the internal sales order or the picking slip. That's what we're gonna use to see. You see how you buy something at the store and then there's like a barcode. There's like a barcode at the back. That is used in warehouses. That's why a lot of things have barcodes because it becomes easier to track. So that is used like, oh, this specific one. He doesn't even want this speaker, we can see it, but he wants a pink one. This person. Alright, then we go get it. So then we remove it from the warehouse. Maybe it goes to the, not maybe, but maybe it goes to a different building, or maybe it's in the same building, but maybe in the next room in that building is now the dispatchment section. So dispatchment section is where now things are going to be delivered. Okay, guys, here is what this person ordered. Pink, small volcano speak. Put it aside, right? And then this, you know how this is almost like what? It's almost like when you go to the store and you find that jean that you want. What are you gonna do? You're gonna go to the till and put it on the till. You still haven't paid, so you're putting it on the till. So you going in that Mr. Price or at Cotton On or wherever you buy your jeans, that's you entering a warehouse and looking for that exact thing. Maybe that you saw online or maybe you saw while you're in there. So then we are at the dispatchment and delivery. 4. Releases the goods to the customer collected. This is then collected by the customer, delivered by the company's own vehicle or sent via a transport company or courier. A delivery note is signed by the customer to prove receipt. Now, what happens here? I don't know who has ordered online. I have ordered online before. I actually am not very frequent at ordering online. Not because I'm just choosing, I just am broke and don't have money. But yeah, so here what happens is now we release this thing on delivery. That's going on delivery. Now you see when you order online, it's this thing says, oh, it's going to be delivered today. You get a notification whether you buy from Shein, whether you buy from Take a Lot, whether you buy from Checkers 60. Is it 62 or is it 68? I think 68. Wherever you buy, they tell you when you're gonna receive it. Like they say, you might it's on delivery today. And then what happens when it's on delivery and goes to your home? You right? Obviously you're waiting in like you're excited. Okay, it's coming. But what happens when it's now like there in your home? You go outside. There's that delivery person. What does that delivery person usually do? They might take a picture, right? Or they might make you sign something. What is that you're signing? It's a delivery note to prove that you actually got this. That's why. Now, uh, there are some. I think there are some businesses that don't do it, but yeah, they might do it in a different way. They still have like a delivery note. So before I move on, does this make sense so far? The obvious is you say yes or you say no.
Yes.
Awesome. Anyone else?
Yeah, bro.
Hmm.
Uh, uh, bro, I want to ask. So the delivery note
Mm-hmm.
is that paper they give you when they like they
Yes.
deliver like items to
Yes.
prove that no man we have given you the item,
Yeah.
and then okay for credit management. I think from my understanding is that it's like they want to check they want to check if this person is he going to is he going to be able to pay what we give him as a credit.
Yes.
Okay, okay, okay. Thank you.
All right. Thank you. Thank you so much. Um. Yes. Okay. So let us continue. Thank you so much for the participation. Um. Now we are continuing. We're going to number 5, which is invoicing. So then, what happens here? What happens here is notifies notifies the customer prominently, like quickly, right? Or yeah, quickly is the best way to say it. Notifies the customer prominently of the amount due and when to pay it. Match back to the original authorized order and signed delivery note. I think that one makes sense, right? And then 6 is recording sales and raising the data. Creates a record of the sales journal, and raising the amount owed as a debtor to the debtor's ledger. Now we're entering territory that we know. So this one makes sense, right? Because we are now recording this. And then number 7 is receiving and recording payment from debtors. So here, receipts are made.
Bro, bro,
Mm-hmm.
what I can add also in number 6 is that what you're going to do here, we're going to increase the sales
Mm-hmm.
and also increase the data. So when we increase the data, is that it's like what we're debiting it or something.
Yes, debit
Okay,
it.
okay, okay. Thank you.
Why? Why do you debit it?
Because we want to raise the amount that they owe.
Yes, because it's an asset to us.
It's an asset. Yes.
Yeah. All right.
Okay.
Yes, that is great. Thank you so much. So here,
Okay. Thank you.
that is exactly what happens in 6. And in 7, receiving and recording payments from debtors. This is where receipts are made out for the cash received. Receipts are recorded in the cash receipts journal, and the correct debtor's account is credited. Now, why is it credited? This person has paid now. That's why it's credited. What was it before? It was debited. But because they have paid, we cancel um that debit what. So now it's credited. Um and then the period total is posted to the debtors control account in the general ledger. So as we credit it um in the debtors control, right, we also make a similar transaction in us crediting it in our account, in us debiting it in our account because we received the money. So it cancels in the debtor's account, but it reflects in our bank because we have now received that money. And then when the period ends and now we are totaling the debtor's control account, we see that less people owe us because they have paid the money. Does that make sense? Now, mm-hmm.
I wanted to make a transaction, bro. What I think we're going to do here, we're going to debit bank because of we're receiving the amount,
Mm-hmm.
and then since they paid the debtors, and at first they owed because of it's like a debit, they owed. Now they pay. So
Mm.
we're going to credit what debtors ledger.
Yeah.
And then the period total is posted. What do they mean about that thing? The period total is posted to the debtors control account in the general ledger.
So I don't know if you remember the debtors control account. I don't know if this was in high school or if this was first year. But
Yeah.
uh, the debtors control account, it's where you see how many people owe you. So the more people don't owe you, the less it will be. The more people owe you, the higher it will be.
Oh,
So
okay.
you are basically seeing who owes you. Debtors control. Debtor is someone that owes you. So
That also is.
yes.
Oh, okay. Okay. Thank you.
All right.
Well, what happens to the task control account? What's going on?
Say that again.
What's going on with the task control account?
Debtors control account. It's where um debtors control account. It's where you see who owes you money. Like for example, if I owe you money, you want to write that down somewhere, right? So you're gonna write down Tosani owes me 5,000. Hey, that's a lot, right? Tosani owes me 5,000. I know. Now, why does it feel like it's actually happening? But yes, Tusani owes you 5,000, right? So you gonna say, this is the money I'm waiting to receive from Tusani at the end of the month. And then I pay that amount of money. So when I pay that amount of money is going where? It's going to your bank, right? that's where that amount is going. It's going to your bank, and when you recorded on the side that I owe you 5,000, so then what happens? Since the debtor's account is about seeing who owes me, I will have to remove. You will have to remove me in the debtor's account. So when you remove me now, the debtor's control account is zero because you have received that 5,000 in your bank. That's what happens in the debtor's control account. Does that? I
Yes,
don't know if that makes
yes.
sense.
But we also record if a debtor paid. We also record in the debtor's control account.
Mm.
And even if a debtor did not pay, what we're gonna do, we're gonna credit that 5,000 rand a debtor owed us
Mm-hmm.
to reduce that account. We limit it to zero because
Mm.
it is likely not to be paid.
Yes, that's true. That's true. That's when now it moves to bad debts. Yeah, that is true. Yeah, that is advanced, the advanced level one. Yeah, but thank you so much. All right. Um, let us continue. Um, to 8, processing returns and credit management. So here, control goods returned by the customer. So this is credited to the debtor's account and manages the overall risk of bad debts. So this is where you know where JKS was talking about. Um, Now here manages the overall risk of bad debts, extending credit only to credit-worthy customers and setting sensible limits and following up on slow payers. Right. Sometimes you give discounts if you pay within this month. There's there's obviously like more and more um yeah, like credit discounts that we can give or something like that, or we extend the credit limit and so on. So this is to encourage people to pay us, right? And then other small activities in the cycle. This is controlling goods that have been returned by customers, uh passing credit notes, granting discounts on payments received, considering and processing bad debts write-offs. Now, something to think about. Why would a company such as a car dealership allow customers to buy on credit, given the risk that they might not pay? That was actually an example that I gave as well here about buying a car, right? If you have no track record of buying that car, it's gonna be harder for them to give it to you on credit. Says here, consider competitive necessity. Most competitors offer credit, higher sales volumes, interest/finance income, and the fact that credit risk can be managed, not eliminated, through screening limits and collections. Now, um, we are going to here. We are going to the documents used in the cycle. I do have also in-person notes that I have on the cycles, which I think are very useful. I feel like they're very useful, maybe even more than this PDF, maybe, because there, I explain like, oh, this and this and this and this. So I'll possibly send that in the group. I'll just take a picture and and send it and make it a PDF and send it in the group. Um, but yeah, let us continue. But this is telling us about the documents used in the cycle. So it goes into more detail, here, um, when it comes to things that are done in the cycle, we have customer's order. What is it? This is the customer's instruction of what is required. Okay, here's what I'm gonna do, right? Guys, I just want us to, yeah, I think we can just like make it like a little activity. Customer's order. The customer's instruction, this is the customer's instruction of what is required. My question is, which department touches this? Customer's
The
order.
order department.
Exact. All right. Let us go to the internal sales order. Compiled by the company's own sales clerk from the customer's order. Authorizes the sales and is the basis for picking the picking slip, especially important to for phones orders. This should be it's obvious. Where is this one from?
Credit manager and sales authorizes.
Say that again. It's credit manager and
Sales authorizer.
sales
Author
authorizer. All right. Yes. Now, wait. I just also want to check so that I don't just say stuff. Um, Where is it? Compiled by the company's own sales clerk from the customer's order, authorizes the sale and is the basis for the picking slip, especially important for phone in orders. Okay. This is, yeah, yeah. I would say that in the credit, but it also enters in the warehouse and dispatch. It also enters there, which is the same as like the picking slip, because in these notes that we're using right now, it says either internal sales order or pickup slip. So there is a difference which is listed here, but the picking slip is listing everything the customer ordered, used by the warehouse staff to pick, um, bracket, gather, close bracket, the goods. Okay, so that is both warehouse dispatch. But to be honest, I think internal sales order can be in the sales authorization, which is obviously credit management, and you could argue and say it's also in the warehouse. But I think, hmm, no, I should remember this. I'm just thinking about something now. Now, the picking slip is the one that's in the warehouse, and then the internal sales order is the one that's in the credit management or sales authority. I think it's important to say also about the sales authority, because sometimes it could not be on credit, just to make sure. So yes, and then here is the warehouse uh, dispatch. Now we have invoice sent to the customer, showing quantity, price, total, discounts, and VAT. Now this one, where is this one? Where is this one? Invoice. I'm also checking something here. All right. So the invoice. So the invoice could be in like multiple departments. Like for example, it could be which department? I don't wanna go up actually, but it's in the. It can be in the. I mean, bruh, the first and easy one is in the invoicing one, and then in fact, you could literally say invoicing, but it could even be in the. Could be even in the later ones as well. But I think I will be better if I just send these notes, to be fair. These notes just make things easier. It's just that they can be hard to read, so you may hopefully excuse me on that one. The physical notes, I mean. But yeah. And then we have the delivery notes. Delivery notes here, what does it do? It details dates, description, quantity of goods delivered, signed by the customer as proof of receipt. Guys, this is important. You see this documents used in the cycle. This is like really important. In fact, like everything is important, but this is really like important. It's important to know where you find this and that so that you can be able to, once you understand where you can find this, well, what this is, you can know where you'll find it up here. Um, yes. And then we have a statement. Statement, monthly summaries sets to the customer, opening balance, sales, receipts, adjustment, closing, and age analysis. This all depends. This age analysis um could be at the start of that credit management department as well. So some places they could like involve different stuff. Like you see here, opening balance and things like that, sales receipts, credit notes and things. Maybe here there's like a bank balance or financial statement or whatever. Here you're able to probably see it in different maybe you can even find it in invoicing, or you could find it in here. But we're gonna get into more detail more. And then here we have a credit application form. This one's the credit this is the credit management where this person has not ordered on credits, so we give them a form. Or it could be someone existing as well, to be honest. Um yeah, so here is completed by a prospective customer so their credit worthiness can be assessed. Makes sense. Receipts records details of a payment received from a customer. Remittance advice sent by the customer with payment to show exactly which invoices are being paid. Remittance register, a list registered of payments received that were not deposited directly by the debtor. Credit note issued by the company to reduce a, a customer's account for a reason other than payment, which, for example, could be goods returned, right? So we return goods to them. Deposit slip, bank document recording the deposits of receipts into the company's bank. So these are one of the different ways we could pay. And then we have price list, referral document of current price discounts used by the sales clerk. Back order note records goods that couldn't be supplied due to no stock, reviewed regularly to check supplier order status. Goods returned voucher made out by the company to record details of goods a customer has returned. And then we have the master amendment form. Computerized systems only records an amendment to the debtor's master file, logs slash variance reports, computer generated records of activity, e.g., a log of master file amendments or access to the debtor master file. Now, one thing I'll say, you won't get this first day. You will not understand this first day. But the more you visualize, how I would advise to study cycles is to visualize it. The more you visualize it, the more easier it gets. The more you see, you think of someone doing it, like, okay, the ordering department, they're doing this, the dispatch, it's almost like you're entering in the store to find your gene, and then the warehouse, and then the dispatch is the other side, which is like you going to the till to now pay, right? And then if you visualize it that way, it becomes easier. Um, but yeah, let us then continue. Control objectives, the foundation for everything below. Before you can list risk and controls for a function, you must know what you're protecting. So when they say control objectives, objectives means goals, what we are trying to get to. So yeah. So when it says before you can list risk and controls for a function, you must know what you're protecting. Every business transaction, not just revenue, is tested against three control objectives. One, validity, which is the transaction is authorized and actually occurred during the period with supporting documentation, so guards against fictitious invalid transactions. So yeah, want to check if that transaction is actually valid. Is it like, yeah, like lane, yeah, but no, and then we have accuracy. Accuracy, the transaction is for the correct amount in the correct account and correctly summarized into the accounting records. And then we have completeness. All transactions that should be recorded are recorded predominantly. Nothing is omitted. This almost reminds me of the conceptual framework. Just saying, because things relate. Now, the three-step method to design an internal
Bro,
control.
bro,
Yes.
I wanted to ask, where does this thing? I think this thing falls under what to call it. Is it assurance or
Yeah. Assurance, like last semester.
assurance, validity, accuracy, completeness?
Yeah. I'm remembering it from there as well. I mean, yeah,
Okay.
was it first semester, right? I mean, it's clearly not this semester. I would probably know. So yeah, I think so. I think so. Validity, accuracy, completeness. Yeah, it has a ring to it in first semester. But this also does such a conceptual framework. I think because I studied conceptual framework more. But yeah. And then the three-step method to design an internal control. Step one, identify the risk. State the indicator and the consequence. Example, sales are made to customers who are not credit worthy, resulting in bad debts. Step two, formulate the control objective. Match the risk to validity, accuracy, or completeness. Example, credit sales are made only to credit worthy customers. Three, design the internal control. Build the actual control activity, manual or automated, that achieves the objective. For example, what happens if a control objective fails? So, fictitious sales are recorded. Fictitious sales are recorded in the financial records. So, like a fake, yeah, a fake sale. So fiction, I think this where this word comes from. We can actually just search it. That's always interesting to just see it. After relating to the character of fiction, yes. So something fiction is something that is not true. All right. Fictitious sales are recorded in the financial records. Consequence: the objective of validity is not achieved. Revenue is overstated. Real case: the JSE find it EOH 75. I will find it EOH 5 million in 2020 for false and misleading financial reporting. Validity failure at company level. Think about this. What reasons might a company have to overstate to understate revenue? And what personal interest might a director have in manipulating it? Consider bonus, share price incentives, meeting analyst targets, covenant compliant, or for understanding tax reduction. This reminds me of consolidations when we have to, check if there's any internal intra grouping transactions. Let's end there. Because JKs and Lebo are gonna do that soon. Anyway. Does that make sense? So far. Please say yes
Oh,
or no.
okay. Okay. Based on that scenario, what do you think why internal control is very important?
Based on which scenario?
This one it says, is it fictitious?
Mm-hmm. So basically, like
Oh,
fake sales are recorded. So why is internal control important? Oh snap! Network. I don't want to answer because she'll come back and ask again. But if she doesn't come back, I'll just say it and she can see this recording. I think let us continue because of time. Let's see. Yeah, I see now it's getting deeper, and this is good. This is like nice. We probably will end here, boy. I'm not sure. Maybe let's see. The legislation check. Not that much. It's probably ended, man. Oh, cash. All right. I think let us continue because she's not here. Um, but to explain it, so why is internal control important? I think here this is literally the answer. The objective of validity is not achieved. Revenue is overstated. So that's why internal control is important because these are the objectives that we're trying to reach. We're trying to make sure that the transaction is authorized and actually occurred during that period. So if it didn't and it was a fictitious sale, then that's a problem. So, but if I could give it in my own words, without even trying to say it in a accounting way and just say my understanding, is now that becomes important because first of all, if I am a shareholder in that company, I'm gonna see like the company is doing well and it's not doing well. And so that's why internal control is important. That's why, corporate governance, because this all relates. Corporate governance and these measurements um, um, that happen here are then, I'm actually answering your question, by the way, JKs. I see you just entered. I don't know if you can hear me. Or she left again. Anyway, um, yeah. So it that's how I'd answer it is basically saying, for me, um, internal control here would then be important because I don't want to, as a shareholder, I wouldn't want uh for fraud and all these things to happen where there's an overstatement or there's an understatement. So internal control is then becomes important and corporate governance becomes important as well. As we see in this example, this company was fined 5 million.
Okay, I'm back. I'm back. I
Yes, you're
was
back.
asking. I was asking that question. Why internal control is very important. So, okay, I will answer it according to my better understanding.
Okay.
Yes. But before that, I just want to define internal control. Let's hey, Marasa. Why are you laughing?
I, but go girl.
Okay, I just want to define control. We already know what internal control is now. So now, kancane, asiphumeni endabeni zika-auditing, ne? And then we come to real life. What is control? We already know what is control, ne? So let me give you this practical example.
Mm-hmm.
Um, let's say you are a parent, ne? And
Yeah.
then you're trying to control your children, ne?
Mm-hmm.
And then you say, okay, here at home, make sure that you come back before 6 o'clock. That's
Mm.
control, ne?
Yes.
That's control.
And it's
So why?
internal as well because it's in your family.
Yes. Why are you controlling your children? You are eliminating potentially risk. So
Mm.
I'm not saying that during the day there is no danger, but at night it's risky. Ne?
Mm-hmm.
Because what if your child comes back, on her way or on his way, and then he meet people and then they hijack him,
Mm.
or maybe he's out there at the wrong time, at the wrong place, and then they kill him. Accident happens.
Yeah.
So when you say here, 6 o'clock, you must be here, you are trying to eliminate risk, all those things. So let's
That's
go
true.
back to that. Let's go back to that scenario. So here I can't say properly, but they says these are the imaginary sales that were recorded in the financial records, and then the consequences. The objective of validity is not achieved. Revenue is over what?
Stated.
Over.
Stated.
Okay, and then the real case here, ne?
Mm-hmm.
um they were fined 5 million, ne?
Yeah.
for for false misleading financial reporting. So you see, there was a risk of recording false information. It's part of human error, where people omit errors. So that's where we are talking about completeness and validity. You must make sure that whatever you are doing is true, and that you need to check, you need to verify to avoid those risks. That's
Mm.
that is what internal control is. So I don't know if you understood.
I understood and I agree.
Thank you.
Thank you so much. No, that was great. Thank you so much. Exactly that. Um, Thank you so much, JKs. Hopefully, we can finish this one. Let's see. Yeah, we can most. No. But wherever we end, we're gonna continue hopefully tomorrow in the morning. But I know tomorrow will finish because it's just gonna be this one left. And then we're not done. Yeah, then we're done. It's just something else. All right. Let us move to more depth. But guys, one thing I want to say, first and foremost, there's a recording here. This recording is actually really good. I can actually send this in the group. This was the recording that this is the class Mobile attended, which is obviously very helpful. But also auditing notes is just like I'm not gonna I'm gonna say it again. Auditing notes is your best friend. In cycles, you can never go wrong with auditing notes in the cycles. This PDF is obviously good, you know, but you'll never go wrong when it comes to auditing notes. This anyway, let us continue. Risks and internal controls, function by function. To be honest, you might look at 5.1. Yeah, because we'll see. So here, what are we looking at? First of all, this is very examinable. Everything is very examinable, but more specifically, they ask around risks and stuff. For now, tomorrow we're doing a quiz, which is less demanding than writing. But I think, is it in 2 weeks? I think it's in 2 weeks. We're gonna have a written one as well. So, yeah, it's very important to know what you're talking about. So here we have the order department receiving and authorizing orders. What is the risk? So what can go wrong here? Orders may not be acted upon timelessly or at all, resulting in loss, sales, and customer goodwill. So you see how this is important. Look, control objective. Which one is being violated? You see here, validity, accuracy. So this is important. Valuation. By the way, I don't know if I say valuation, bro. No. But here, what can go wrong is orders may not be acted upon timelessly or at all, resulting in lost sales and customer goodwill. Basically, what they're saying, you could try to order, but no one comes back. Like, you know what the example of that is? When you're scammed. When they scam you. See, when they scam you and you order something and you pay that man, you might even pay that man, might even be on credit, like cash. Ivana, what online? Ta. No email. You refresh that email thing. Ta man, they'll send it tomorrow. That's the first stage, denial. Then pay it tomorrow. It's like no, they're not sending this thing anymore. So that usually happens in scams, but it can also happen as like a problem. But yeah, in a business it can happen where orders may not be acted upon timely. Maybe they didn't act upon it immediately and it might take some time, or not at all. So what is a key control activity? What can we do to minimize this risk, or fix this risk, this issue? Record all orders on sequentially numbered internal sales orders. So what they're saying here is write the exact detail of that order down. So I think the best example to give is like barcode. So you see the barcode sometimes has numbers, long numbers, what number. You write that exact number. So record all orders on sequentially numbered internal sales orders. And then sales clerk attaches the customer order to the ISO. A supervisor checks the ISO sequel regularly for missing, cancelled numbers and follows up on delays. So you see, record all of the sequential numbered internal sales orders. Sales clerk attaches the customer order to the ISO. So you see, the customer order is in here in the order department. We also find what's in the order department. ISO, right? And then a supervisor checks that ISO to see if there's any missed or cancelled number of following delays. What is this for? Completeness. What is completeness? All transactions should be recorded. All transactions that should be recorded are recorded promptly. Nothing is omitted. There's no error. Nothing is wrong. Second, what's another risk that can happen? Inaccurate or incomplete order details recorded, causing wrong or returned deliveries and customer dissatisfaction. This has happened again. I've seen this, I don't know, but someone once bought a PlayStation on Takealot. Now I'm not saying this, in a way that's like Takealot's a scam, but basically from Takealot. So how much is a PlayStation 5? Like, I think that thing is like maximum, at least entry level, 10K, right? On average, 10,000. And then when they opened that thing from Takealot, what came out there was not a PlayStation 5, but was maybe like I forgot what it was, so I'm just gonna draw. But it was like maybe Stay Soft or something, but it was something along those lines. So like a Stay Soft or something. So that obviously caused customer dissatisfaction. So it's heavy. It's heavy like a PS5. It's heavy like a PS5, so you can feel it. PS5. But when you move it, it's like, why not? There's 5 controllers in this thing. So that does cause customer dissatisfaction, or maybe someone orders something, like I order a pizza and you give me a burger. I'm gonna be annoyed, like, hey man, what's going on? So that is what can happen here, risk that can happen. So what is a key control activity here? Sales clerk attaches customer order to iOS, agrees details. So now they are checking here. The customer order in iOS agrees details, so price, quantity, description, customer reference, and confirms delivery price details back to the customer. Control objective, accuracy. So by the way, I don't think these are all of the risks. If you look at auditing notes, there's probably more, but these like are one of the risks. If it's all of them, then hey, it's all of them. And then the second one is orders accepted without sufficient stock on hand, causing delivery delays and dissatisfaction. So this is when you wanna buy, um, let's use a PS5. You wanna buy a PS5, and then they say it's in stock, but then it's actually not in stock. What ends up happening? Me as a customer, I'm dissatisfied, and that causes a delay. Maybe now they have to get it from the warehouse in Cape Town, when they said here in the warehouse in Joburg, you could be able to get it. So that's what causes delivery delays. So what must happen here? Sales clerk performs an inventory availability check before confirming the order. If out of stock, a back order note is raised and followed up regularly. Another document that is here, this is very important, by the way, to know which document is where. Here we see there's a back order note. We see also we had the ISO, we had a customer order. Yeah, that's what we've had so far. Now, what is that control objective? completeness, and accuracy. So you see, there can be more than one control objective here. Now, looking at the last risk, we'll definitely end here today. Orders accepted from a non-account holder or a customer who cannot pay, resulting in bad debts. Think that makes sense? New customers, credit application is checked, trade references, credit bureau, and approved and authorized by the credit controller and financial manager. Existing customers check against credit limits and terms before the order is filed. Why? Validity. So, does that make sense? So,
Yes, bro. What I wanted to add again, you can even lose trust on customers.
yeah, like customers can lose trust on your business.
Can never trust you because of, like, you believe me, for example, as you made the example of PS5,
Ah,
and
no, they would never.
they never trust.
Ah, they're cheap. Like, bro, I look at the wall for a good 1 hour. Oh,
Yeah, they never trust you.
yo, 10K. Like, you're
10K.
10K.
Eh,
But
eh.
in that instance, Takealot gave them the PS5, by the way. But yeah.
But another thing, do you know? Let's say you buy something on Facebook,
Mm. Yeah, that's
and
also
then
a good
after,
example.
yeah, after buying that thing, maybe someone sells your car on Facebook. You pay that amount, and then that person, for example, uh, is nowhere found.
Mm.
Would you trust that person again?
Yeah, you won't. But first of all, like you won't even hear them again. you won't. You don't even.
You know, they're gone. The
They're
money's
gone.
gone.
Like they didn't even want trust from you. They just wanted the money left.
Eh,
And
eish.
and you see a new Facebook account that says new, and it's that same car.
And he will think that it is a car, but no, man, it's a
yeah,
scam.
yeah.
It's a scam.
Yeah.
Uh,
So
thank you, bro, for the class. We did enjoy.
thank you very much for your participation. So
Uh,
if anything, guys, just to close it out, what's important? First of all, I'm gonna send my notes. Um, I have to, like, I'm gonna send them today. I'm just gonna take pictures here and just throw them in the group. Um, I'm gonna try to make it PDF so that it can be easier to see and it's not in your gallery. But what's important here is to understand what is the order department, like understanding these like sets. Please, this is a summary, so do not use these exact notes to just straight up study. You know what I'm saying? Like, check the proper wording um in um in the learning material. Like maybe they might call this like warehouse instead of dispatchment or something like that. You see how the revenue and receipt cycle is also called the sales and collection cycle. Maybe the notes call it, the notes call it revenue and receipts. But just to make sure, like on a couple of things, and not rely on these notes to just study. This is just a summary. When you're looking at the summary, you can then go deeper into auditing notes. So what's important is to understand each department, each cycle, the process of it, and then the the um the documents that are in that cycle, and then this. Then you're good to go and you're able to understand. And sometimes they can even give you a risk here that, you see, once you understand the order department, they can give you a risk that is not even in the auditing notes. But because you understand the order department, you can answer and get a mark. So that's why it's important to understand, like even with this, let's say you don't even look at auditing notes, but that one is risky. But let's say you just look at these risks and you thoroughly understand, you can be able to answer if you know what documents are there in that cycle, because if those are the only documents that are there, there won't be any other document there, so you'll be able to answer questions. So thank you very much, guys. That's all I wanted to say. Please do check out the video that I put in the group. This will be uploaded on YouTube. Hi, we are low-key YouTubers. What's going on now of teaching? What if one day people watch these things like, hey, oh, let me check on YouTube to understand auditing. All right. And then they find this. Anyway, it's thinking in what's. All right, but thank you so much, guys. See you tomorrow for the last auditing class of the week. Hey, bye. All right, bye.
Thank you so much. Bye.
Thank you. Bye. All right, that's the end of class. Like, share, and subscribe. Since we're already here.